Thank you everyone for joining to our monthly recap call. We're going to look at the month of October and is sort of historically good. So Michael, what are some of the thoughts on recapping October and maybe a little back to September?
Sure. So October S&P was up about 6%. Is the best month, give or take, since last November. We had all the indices start hitting new highs, and then you also saw the VIX, which measures volatility, drop to its lowest level since July. So you had a really nice, smooth, even month. And going back to September, there were issues with supply chain, labor shortages, just unknowns about taxes for both individuals and corporations. And you also had a lot of debt ceiling concerns. And so as those got resolved in October, that's really where you saw markets really pick back up, especially with earnings doing as well as we've seen them.
Yeah, and you look, Michael, earnings is kind of the key. I mean, you had over 80% of companies beat expectations. And again, as we looked into this month, we were looking for supply chain. You clearly had companies that were impacted negatively by the supply chain, but for the most part, companies really navigated well and stayed ahead of the curve. And when you look at the rally of the markets, the overhang of the tax policy and debt ceiling, I mean, so far what we're hearing in taxes, it's maybe not as high as expected. So it's been good, and give the Democrats credit on, I think, really good point is the minimum corporate tax. I think that's a great way to raise revenue, and it really is efficient from a short and long-term standpoint. So I think the markets really liked a lot of the tax policies of what's ahead and how to pay for some of this. And you look at the Fed. I mean, the Fed came out yesterday and really kind of, Powell's been very good to kind of perfectly explain what the market wants to hear and deliver, and tapering is really where things are. So the market seems to be favorable on everything from that standpoint, and first two really helped explain the rally of October.
Right, and to talk about tapering a little bit, just to go through the actual mechanics of it. So right now the Fed is buying about $120 billion worth of treasuries and mortgage-backed agency bonds per month. And the idea of tapering is to reduce that by about 15 billion each month. So it'll take from November through about June to go from 120 billion to zero. But the idea is that the Fed doesn't feel it needs to support the economy as much because we are doing as well as the numbers have been stating. And this gradual decrease should allow markets to adjust, companies to adjust, and gradually get down to that $0, just sort of additional purchases by mid next year. And so with that, you would generally expect to see interest rates start to rise. And I know that we're starting to see predictions for the Fed to start actually increasing rates in next year as well. So JR, could you talk about why the Fed would look to be increasing rates and when they may look to do so?
Well, the Fed's in this weird position right now where the inflation's uncomfortably high, and they still believe a lot of it is transitory, but they sort of hinted earlier this year that we'd kind of be through this phase by fall. And here we are approaching winter, and you're pushing this into next year. The other thing that's interesting to watch is their discussion around employment. And there's always been the dual mandate from the Federal Reserve is full employment and control prices and control inflation. And right now you have employment that isn't back to where it was, and you have inflation that's uncomfortably high. But now there's discussion around full employment really shifting to maximum employment. That doesn't sound like a big change, but the reality of what's happened since the pandemic is demographics changes of the labor force. A lot of people have retired permanently, and there just aren't as many people coming back, and there might be a permanent shortage of 5 million workers. So we might not get back to the full employment that we were pre-pandemic, and it'll be this new discussion around maximum employment. But the challenge with maximum employment, having 5 million fewer workers, is if you think about it, competing for the workers ahead, you're gonna have to pay more. So the labor inflation is not likely to go away. So it's something that the Fed's really gonna be challenged. And going back to the interest rate question, Michael, it's probably why the market is forecasting an increase in June rather than December. And that's really a big change in the last month or so, that the Fed rate hike is priced in sooner than before, and actually 2 rate hikes by December of next year.
Okay. So as we kind of look towards the end of this year, I mean, near term, optimism, I think, still prevails, whether it's, companies increasing their stock buybacks ahead of the buyback tax that's, set to go in next year. You should also see holiday spending, even with supply chain issues, even with some shortages, that you should see a bump in consumer spending during this next couple months. And just generally speaking, the tax increases haven't been so bad. So, that looks good for the next, month or two, short term. But as we get out, towards next year, we don't always want to seem as though everything is, rosy and perfect. But, what sort of concerns you going into next year?
Yeah, looking into next year, Michael, I think, as we said last month, we expect the markets to come back to new highs. Here we are. And near-term landscape of everything you went through supports the markets probably remaining pretty high between now and the end of the year, just given the short-term wind at the market's back in a lot of ways. But as you turn over to January, you're gonna have a little bit of inflation concern, wage inflation, a lot of the headwinds, and then you get into the Fed. The Fed, as you said, with the market pricing in a rate hike by June, you're really figuring that the tapering might end in March instead of June. So you're going to have a tighter Fed next year overall, just to try to control inflation. So it's just going to be a bigger headwind next year. Market's not concerned about it right now, but as we turn into next year, we think they could. And as you look at some of the trends that have been interesting in this earnings report season, has been this concept of variable or floating dividends. And you're seeing this in a number of commodity companies and in different areas where you pay a fixed dividend and then a percentage of cash flow. So the cash flow and value-oriented investments have done quite well. And if you look into next year, if we see sort of a flatter overall market because of the Fed tightening and higher inflation, the value and dividend-oriented stocks could continue to do really, really well. And it'd be a place to watch and rotate to if the market is a little bit uncertain into next year.
Okay. So what you're saying is really stick with more the value names, whether they're in the financials, sort of energy names, or commodities. That should be sort of how we look to protect if there is more, uncertainty or a bit more volatility going into next year.
Correct. And you just look at this earnings season, a lot of the big tech companies or the biggest companies are pretty fully valued, and the valuations are much, much higher, and most of them pay little to no yield. So you just don't have as much protection from a valuation and cash flow standpoint, and they just feel a little bit sideways overall. Again, you look to need another level up of growth in some of these to drive next year, and you just don't see that as we look right now recapping this earnings season.
Okay. All right. And I guess as we wrap up, being in November now, Thanksgiving later this month, I think the question everybody has on their mind, JR, is how big of a turkey are you guys cooking this year?
Hopefully you can get it with the supply chain, right? So it'd be really a challenge for holiday planning and everything else out there. So with that, thank you everyone for tuning in. Hope you have a happy Thanksgiving. We'll catch up next month.
All right. Thank you, everybody.